Stocks finished up a second straight week to the downside, but it is actually less bearish this week than it was last week. So really wasn't that big of a decline. So is the worst over? And that's what we're going to talk about today. What are some of the technical signs telling us in terms of is the worst over, or is the worst yet to come? In terms, I mean, we're not talking like, we're not going to tank, but is the worst of this particular intermediate pullback left to come? So we're going to talk about what I expect and why, and what the signs are indicating, and we're going to take, as we always do, look at the different asset classes. Some pretty interesting moves today in bond yields coming out of the PPI number that was slightly hotter than expected, just slightly. I heard some people talk about it was much greater than expected, much worse than expected. It's like, it was just barely hotter than expected. But it was enough to make an interesting move in yields. We'll talk about that. And we'll talk about the move in the dollar as well. Making some pretty strong moves here lately. So we'll talk about that move, especially against the Japanese yen. And then, of course, the sector rotation, as always, is a discussion. And then our trade idea. We'll take a look at a stock similar to our last trade that is beginning its own intermediate decline potentially. And similar to the market outlook, hasn't been that bearish. So we'll talk about how to trade that kind of a stock. And let's go ahead and get started. Today is Friday, August the 11th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today down there. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things on the right, including our Market Outlook live video. If you come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers. It's a big deal for us. That's why we always ask for it day in and day out. So thank you those who do like it every day. And those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had a down day today. It was not that much of a down day. We actually finished higher than where we opened. So you notice we're getting a lot of open candles during this decline. It is the third down day of the week. And if you look at last week, we ended up with 4 in a row. So we're looking at about 7 out of the last 9 trading sessions here, if I do the math right. 7 out of the last 9 trading sessions are all negative. Before that streak started, you can see we had intermediate line at the 89th and pretty much 90th percentile. Market sentiment was at the 85th percentile. Now your market sentiment's down to the 83rd, and your intermediate line's down almost in the lower half of the chart. The near-term line did not peak in the reversal zone on that peak or the one prior. So we had a couple of bearish peaks in the near-term line going into this bout of weakness. But now the last near-term peak didn't even get in bullish territory, and we're back in the lower reversal zone. So we are falling here. The nice thing is we're not falling sharply. We're not down. We're only down, 0.8% below the moving average. We really start to get concerned when you're 2.5%. That's kind of what the stage you need to be in a bearish decline, and we're just not that point. Again, we got the bull tag here. We've gotten 2 bull tags in this past week, since last Friday, and we haven't really extended to the downside, a little bit, but we haven't bounced either. So we're still kind of leaning to the downside, but not necessarily breaking down per se. If you look at the NASDAQ, which has been the weakest, the intermediate line is in bearish territory now. So we are in intermediate decline. Even if we don't quite have a red arrow yet, you are almost 2.5% below the moving average. We did close near the lows today, so a little bit more bearish on the NASDAQ 100. You can see its market sentiments a little bit further down, still in the reversal zone, but still further down. Short-term sentiments both in the lower reversal zone. Your Dow Jones Industrial Average, on the other hand, has been the most bullish. It's actually I mean, you were back to dark green shading and a green line. So everything else is in bearish decline, and the Dow has got dark green shading and a green line, just like that. The intermediate line is back up. It's back, not quite above 80 yet, but it's turned back up here. Hence the dark green shading because you're above 50. Short-term sentiment did not get into the reversal zone, so I mean, this is actually it's actually a pretty good, short-term bounce you would expect. Now the last two peaks weren't that bullish. And this last bottom wasn't that bearish, so we'll see, how things end up going into next week. But as of right now, that's a pretty good bullish pattern. In the middle, in between the Nasdaq and the Dow, is the Russell. So the Russell is also formed a bull tag. Its intermediate line is still in bullish territory, not quite in the lower half of the chart yet. Its short-term sentiment did kind of get in the reversal zone, but not to extreme lows. And you can see since the bull tag, we actually have kind of pulled down a little bit more, not to an extreme. We're still like the S&P, you're only 0.8% below the 30-day moving average, but still a bull tag that you either bounce off of and we just get going, usually within a day or two, or we don't. Right? It starts the weakness if it doesn't get back to dark green shading and green line in a day or two. And as of right now, we've gone 3 days there with the pink shading, or 4 days with the pink shading, 3 days with the yellow line. And you notice here we've got how many, 1, 2, 3, 4, 5, 6 days with the pink shading, and 4 of those days with the yellow line. So again, it's one thing to get pink shading for a few days and yellow line for like a day, and then you just get right back up, right? But we're not getting right back up here, and that's the problem with expecting that this will be a bounce back up. Here's the other problem. You notice the short-term sentiment is about as bearish as it's been. The momentum line last week dipped into extreme lows on the weekly chart. That hasn't happened since the banking issues, and it actually got lower this go around than it did then. Got down below the second percentile. The near-term line did drop lower than it's dropped in a while. It got below the 7.5%. Back here it got to about 9th percentile there in December. So I mean, it was in full-on decline mode last time it was this bearish. In fact, the last time it was this bearish in bullish mode was over here in September 21. Your market sentiment line was very high. Everything was pretty high, and you just had a weekly cluster. And then right on this week right here, you had the short-term sentiment, and it led to the first intermediate decline there in 2021 that we had since October of 2020, right? So we had gone almost 11 months without an intermediate decline. So that at least staged the beginnings of that decline. Very similar to what very well may be happening right now. Remember, we do have this divergence here of these lower highs combined with higher highs, the low point somewhere kind of here in the middle. So, I mean, this suggests that we're a lot more bearish than we think we are. The Nasdaq, remember, is the most bearish. Its near-term line dipped all the way to the 5th percentile. The intermediate line was so strong, this is barely crossing potentially below the 90th percentile here, so very, very strong. But you notice it just, during this entire bullish run post-COVID, the near-term posture never dropped down to this low. And it's doing it now. I mean, the near-term line dropped below the 5th percentile. It did it over here, and we were full-on bullish mode when that happened, or bearish mode, excuse me. So we are 10% above. That's a pretty strong level if you follow my cursor to the left. But that short-term decline suggests that things might be shaking up a little bit in the Nasdaq. It has not broken its 23% retracement of this intermediate rally. The S&P hasn't either. So technically, we haven't started the retracement yet. If we're going to retrace, which typically happens when you break the 23% retracement, then where the intermediate line, remember, is already in bearish territory, but we haven't broken that 23% retracement level yet. If we're going to retrace, then you typically break that and you end up falling down towards one of these other levels. You can see this 14,390 is where the 38% retracement is for this current intermediate run. It happens to also line up with other Fibonacci levels based on other time frames. So there's going to be some pretty strong support down here once it gets down to this 14,350 area. So about another, 650 points of decline potentially for the NASDAQ 100. Let's take a look at the other weekly chart here. If you look at the S&P's weekly chart on this, you can see the reversal. Like we finally went negative on the candle down here. It can go negative and still stay bullish during a bullish run. So that in and of itself is not the issue. And we don't have a red arrow, so we never did get a red arrow here or here. And this is that week we talked about in September of 21 where the short-term sentiment was pretty bearish. It took a few weeks to finally get that red arrow. Probably, if we don't get it, we didn't get it this week. But if we're going to get it, we'll probably get it next week on this. And if we do get it, if it ends up being a week kind of like what we've seen before, similar to what we saw at the beginning of 2022, where you got the transition candle, you got a bearish reversal that wasn't that big, did not produce a red arrow. So a red arrow is a cross below the 10-week exponential moving average. The next week it did, and we see a number of examples where after a week, bearish week, things got much more bearish the following week, and that the potential for a much more bearish week is heightened for next week, considering how we are in this transition mode. And you see that transition as well in the hull, like breaking the 200-day hull. It represents a transition mode. That's typically an intermediate decline, as you've seen over the past few years. Let me zoom out over here. You can see some of these others. But really, when you break through it, and the line turns red, that's typical of intermediate declines, even during the only one that we had in 21 there after so long. And of course, this is what happened in 22 during the correction. You were pretty much red that entire time. But it doesn't turn red until you're at least below it first. And now this is the first time in a long, long time that we're below, at least this much below, with as much negative momentum that we've had. This is different than any of these other little declines. So more negative momentum, bigger negative candles than what we've seen in a while. And of course, the 20-day hull is red. The parabolic SARs are up. So we are in transition mode there. Of course, on the weekly chart, we have flipped the parabolic SAR to the upside this week, which again is another signal that things may get more bearish next week now that we finally have transitioned that. So we got the candle to turn south, and that's a relatively decent sized weekly candle, relatively speaking. It's kind of met the minimum that we see there of 2.5% on a weekly chart. This measures the size of the body. So, but it obviously can get bigger during these intermediate declines, as you would expect it would. And we've gone, however many weeks it's been now with the green hull. So 1, 2, 3. Let's see, we started here. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 14, 15, 16, 17, 18, 19. So next week and the next week won't turn red either unless we really drop. So you're looking at about 19, 20 weeks, which is that's about the time frame that you get on these whole moving averages. 200 would be the for here, right? If a 200-day hull, you look for 200 weeks to occur, and we didn't quite get that there. We were green for quite a while during that bullish run, and obviously we've been green. You zoom out a little bit more, there's been longer periods of green, right, where we were green just about this entire time coming out of 2011, going into the 15-16 correction, without a correction there. So, but again, the parabolic SAR flipping here, and the bearish candle, which is a pretty decent sized bearish candle, suggests again more weakness to come in the next week, or especially potentially even this week, this next week, upcoming week. If you look at the 3 green arrow charts, again, you see another sign. We're still pink shading here. It's one thing to get 3 red arrows, but you should bounce right back up with at least 1 green, like we did here on the Qs, and technically we did on the S&P. It should bounce right back up with at least 1 green, and it didn't. Right now we're 4 days on the Qs, 3 days on the S&P, 3 days on the Russell, still not a single day on the diamonds, though we don't have 3 greens, right? We have 2 reds. So, this chart suggests that we are more than likely going to be starting an intermediate decline as we're picking up the days, as we're racking up the days here. Also, you can see we are flirting with the 50-day. The S&P did not break below the 50-day, famously, right? There's been a popular topic of conversation among a lot of talking heads here on TV. You can see there's not a lot of volume below that, though. You break the 50. The concern with breaking the 50 right now in the S&P is there's a lot of gap to get down to the 200. And there's not a whole lot of volume until you get down towards, this old 4,200 area on the S&P 500. The Qs did break the 50, right? So the Qs have broken below the 50. The MACD and stochastics, the stochastics, same with the S&Ps. The average for the stochastic is in the reversal zone. So that doesn't happen on a whim. It's another sign that we are more bearish than we think we are. And things can start to pile up. Look how big the gap is there between the 50 and the 200. So we can fall, to get down to the value area, we can fall all the way down towards, the last August levels pretty darn easily, 330 on QQQ. I mean, things can really start to turn south very rapidly. Remember, and it's not just on a absolute basis, but even on a relative basis. We look at the Qs relative to IWM a lot here. So if you look at them, you can see this is on a weekly chart, but if you go to a daily chart, you also see a pretty sizable gap between the 50-day and 200-day moving averages of the ratio chart of IWM to QQQ. Let's go to a 1-year chart here. And you notice, we are in that gap. We've been below the 50. The 30 has now crossed below 50. We're below the 8. I mean, we are in bearish mode. That long-term moving average, as you saw, is pretty high between that 50 and 200-day moving average. That gap is pretty darn high. It's the highest it's been outside of the COVID peak. It's the highest it's been in 20 years. So that's a lot of space to fill in. So it's going to put a lot of pressure on the Qs, both on an absolute and especially with the lack of volume, because we moved up so fast over here. The lack of volume there is going to, there's a Fibonacci support level right here, like I said, at that, 350 on Qs, and the equivalent level on NDX. And that's the one I pointed out earlier. But it's not going to be very strong because there's not very much volume there. It can pass through there pretty easily until you get down closer to the 62% retracement and the 50% of the correction, the 2022 correction levels. So again, after looking like we're going to really break above the 78 and get going and change, it might end up being more fake out than breakout, having gotten up to that point. Let's look at some of the other oscillators here. Let's look at the DMI. Again, both lines on the positive and negative indicators are pretty low. Again, that's bringing the ADX down as we're really not dropping very hard, and we're getting a lot of open candles, and we're not, we were bearish yesterday, but we finished today higher. So we're not really strongly bullish, we're not really strongly bearish, so we're pretty weak in both of them. And that's why they're both sitting right around 20 right now. The Qs is a little different. We're closer to 25, and the positive indicator is down below 20. IWM, you can see too, its positive indicator is way below. It's pretty significantly below 20. As the positive got up to 25 and pulled back, or the negative, got up to 25 and pulled back there. Of course, your diamonds is still pretty bullish, right? The negative indicator is very low. So still pretty bullish on that. The RSI and the CCI are also, again, are bearish, not strongly bearish yet. The Qs is a little bit more bearish, or the NASDAQ is a little bit more bearish as we are closer to 40, well below 50, and have been below minus 100. If you look at the Qs on the weekly chart, again, getting below minus 100 suggests that this bullishness is over with. So we're not there yet on the NASDAQ or the S&P. But those are factors to watch next week. To see just how bearish we end up next week. Looking at the Ichimoku cloud, remember we had lost the trend this week. We lost the trend on the Qs, we lost the trend on the S&P, we lost the trend on IWM. Only the diamonds is maintaining its trend, but it's weak as we're below the green line. The Qs, the rate of change is only slightly positive, actually might be slightly negative. but that's where the rate of change, that's how close the rate of change is to going negative. SPY, it's slightly positive, but again, that's how close it is to going negative once the red line crosses through the price from 26 days ago. So again, another sign. I mean, this is an intermediate reversal sign, right? And like having gone intermediate bullish to intermediate bearish, that's what the reversal sign is, when you've lost your mature trend. So that's another factor not working in the favor of bullishness in equities right now. And then of course, again, we're not, and this is why we're not bearish, because we're not in the lowest quartile. We're still in the, we're still just above the lowest quartile. We only had one day this week where we finished a smidgen inside of the lowest quartile. So the bands themselves, because of that, the band themselves still finish pretty much every day this week inside the Keltner channels. So last week we talked about the potential last Friday of it going red, and it did on Monday, and it's been there all week. And but you see the bands are expanding slowly as we're close to that lowest quartile. If we were to break, and it's not a big drop to break, if and when we ever were to break down outside of that lower band, just to kind of give you an idea, and the band's going to be a little bit lower next week. But for us to get below, let's say 441 gets us below that band, that would be a 1% drop. So if we do get a 1.5%, 2% drop at all next week, that's going to get both below the lower band and the Keltner channel, and that's the kind of breakout move that says, okay, here we go, we're here to stay. We just haven't got that yet. We didn't even get that. I mean, you can see we've only had 1% decline. It didn't even drop below 1.5%. So 2% declines are kind of what start these intermediate pullbacks. The last one started there in February. So 2% declines typically start these things, and we haven't got that, right? We haven't been too strongly bullish, but we haven't been very strongly bearish either. A lot of that has to do with volatility. Volatility is still pretty darn low. It finished barely above 15, so we almost fell back below 15. I mean, and we dropped all the way to the 85th percentile. Like, equities are bearish right now, and the VIX dropped 6% today. I mean, obviously the market didn't fall hard today, but I mean, we are in a decline. We are in the beginning stages of an intermediate decline, and the VIX is dropping while the VVIX is actually holding up. That's why you see a little bit of a turnover in the 10-day correlation. So the VVIX is saying, hey, we shouldn't be, right? We shouldn't be this low. But the VIX finished the week way low, way lower than you would expect it would be based off of how the markets are performing. Where we pretty much have had 2 down weeks here in a row, even if this week wasn't that bearish. We did close back below the 17-day average. We're still above the 50-day average, and the 30-day now is crossing above the 50-day average. So, if we were to stay below 15 next week, get below 14, then we're done, right? This is the intermediate pullback. It's about as weak as it could be, but we're done. In fact, you wouldn't even call it an intermediate pullback on the S&P, because you would expect the bull tags to hold and bounce, and we'd still be on the intermediate rally to the upside. So this is really important to watch as these other indicators are already rolling over to the downside. Very, very, now you can see they can roll over temporarily and turn right back up. So that's not out of the realm of possibility here. It's important to watch what we do back with that 50-day average on the VIX. Do we get back below it and stay below it? There's not a whole lot of room down to these lows. I mean, the 50-day average has fallen so far this year. There's not a whole lot of room down there. We'd have to really not just get down below the 50, but probably break down below 13 and really put some pressure on volatility. That's unlikely, considering, again, the seasonality for the VIX this time of year is bullish, right? The seasonality for the VIX this time of year is bullish. There is some weakness in the VIX around this period of time, as you can see. Even pretty much right on this day, it tends to be pretty bearish, and that's what we saw here. But then you can see we tend to bounce. Going into the end of August, we tend to bounce into the beginning of September, and some weakness before an even bigger rally at the end of September going into the middle of October. So I would not expect us to break 13 on the Qs and really break down hard. I would expect that it'll be the other way around. That we are going into next week with the VIX set to pop right back up to where it was, if not more so than that. One last chart I want to look at here. Another sign that the intermediate run has started is the Arun indicator. We did break up to 100, and we've gotten new lows this week, new 4-week lows. There's that quasi runaway gap there. All the other gaps this week filled in, so we don't have to worry about, like we talked about, like that gap on Tuesday morning. Are we going to fill that in? And we, in my class that day, I talked about, more likely it will, so don't get too worked up about the weakness there, and it did by Thursday morning on the CPI. But then we filled in that CPI gap, and then we filled in this morning's gap with the rally today, and then this kind of finished below last week's low, but above yesterday's low. So in kind of this neutral range, but not back above. It would have been a lot more bullish had we closed back up above even last week's low point, and didn't. So a lower low on the week and a lower high, very, very, very lower high for the week, which is the CPI high, and then the lower low this week as well. And then even today, a lower high and a lower low too from day to day. Again, setting us up for more weakness to come. And as the only one that has not given us the bearish indicator here, the Qs has given us the bearish crossover, and so has IWM with their ranges very low, suggesting that we are set up for that range to expand, which means, again, more weakness to the downside, this kind of a move eventually. And maybe not next week we'll get that kind of a move, but we'll start to get some bigger candles here potentially next week. You can see over here how it started slower and then it picked up as we got some weakness there. So that's kind of, I think, the weakness. I don't think this is the bulk of the weakness, even though we've been on this kind of streak now of however many days. For the Russell 2000, it's been 1, 2, 3, 4, 5, 6, 7. 7 out of 9 days to the downside, and some down days there in that sideways action. So we've been on a little bit of a streak for a couple weeks, but the selling really hasn't started. Like, this hasn't been a pullback really yet, and really the pullback really gets going when you're above, at least above the 95% mark here, and we just barely flirted with the 90% mark last week and early this week, and we've been below 90% for most of this week. That does not scream pullback at all. So the pullback really hasn't started yet, and if once it does start, you're going to see worse moves than what you saw this week. So I hope you didn't think any of this week's moves were that bearish. All right, let's now take a look at what's driving this price action. You can see again the 3-month returns, but let's just look at just today alone. Again, post PPI, and take a look at what we saw. As you can see, initially there was some weakness on equities, and then we rebounded, filled in the gap on the S&P 500, did not fill in the gap on the NASDAQ or on EFA for that matter. Remember, EFA and emerging markets, they're a little different because most of their markets are in the overnight trading session, so it's not as significant for them to fill in their gaps. But emerging markets were down 1.5%. So they started off the day already pretty weak. You can see the strength in the dollar there. IWM way outpaced the Q. The Q's ended up down 0.2%. IWM was actually up almost 0.25%. You can see gold outpacing most equity asset classes, but not quite the dollar. Gold also outpacing bonds, which again is another interesting sign, but a lot of that has to do with yield. But again, with the strength in the dollar, you wouldn't expect gold. So a little bit of a risk off move going into the weekend. Here's how the full week performed. So the dollar ended up the week pretty darn strong. The biggest asset class gainer of the entire week. Emerging markets, as a result, not surprisingly, the emerging markets ended up with the biggest loss of the week because of that strength in the dollar there. So they're struggling. Gold ended up being down. So today's weakness again, or strength, excuse me, in gold was just an outlier. But you can see bonds were down. Again, that's a reflection of bond yields really ramping up from the open on Thursday to the close here on Friday. So a pretty significant move in yields. You can see the Qs kind of following bonds to the downside. They've been relatively positively correlated over this inflationary period that we've been in, and that continued here. And then finally, you can see up to the upside. EFA not nearly as impacted. In fact, going into today, EFA was one of your bigger asset class gainers for the week. It ended up down with a new high move higher on the dollar today, but still outpacing most of these U.S. equities, including IWM and Qs, which are kind of moving hand in hand. Initially, IWM was the biggest weakness for most of the week until today. The Qs fell, and they both ended up kind of down by the same amount by the time it was all said and done. You can see, despite the Qs being down as much as they are, and despite how big of a market cap weighting they have, they did not drag SPY down very much. So it kind of goes to show how strong some of the other areas were. You'll see here in just a second. But let's take a look at that dollar move. The big strength in the dollar. I remember, strength in the dollar is not necessarily the best thing. We had this big breakdown a few weeks ago, that week of July, and then I went on my vacation. Actually, kind of after this week, I went on the vacation. But since then, it's like pretty much nullified that breakdown and pretty much turned it into a fake out, right? That ended up being a fake out pattern, which is more bullish, as you can see, more bullish than just than it had support held in the first place. So, and now 4 weeks later, after breaking down pretty hard below that 30, we're now above the 30. Just like that, we're back above the 17. In fact, we closed above the 17-week and the 30-week this week. That's a pretty decent move. The MACD has crossed back above its moving average. Stochastic's crossed back above its moving average. So since the beginning of the 17th, the week of the 17th, let's look at the currency comparison chart, and let's go to July the 17th. So right here. So since that time frame, again, you can see just how strong the dollar has been. It's up against everybody. The Swedish krona and the New Zealand dollar down the weakest. You can see the Australian dollars down there too, along with the Japanese yen really struggling there. The Japanese yen is struggling. You can see the European currencies, in particular the pound and the franc, performing relatively well, but still down to the dollar, and down quite a bit. The euro down just 2.5% here. That's quite a bit of a decline against the U.S. dollar after what South African rand started off this period pretty strong, and the euro was a big weak one to the downside. Now a lot of these other currencies, including the pound, ended up being down worse. The pound down 3%, just in time for us to go on our vacation here with some strength in the dollar. Just wish it would have been a little bit stronger than it was, but just in time for our vacation there over to Northern Europe. But that's a big move, and it's got some implications, right? There's some implications for the dollar index turning that ship around and turning back up again. You can see this week getting a green arrow back on its weekly Hakinyashi candle, and back on that 10-week exponential moving average after getting the transition candle and then the higher close. You get a slightly higher high and an easy higher close. And as of right now, we're trading at, the open will be right around 102. We're trading at 102.85, which is up here. So we're going to get a pretty decent sized candle to start off the week next week too. So the dollar, now the question will be whether we get back above the 40-week and then stay above it. The last two attempts we got to the 40-week, we didn't. So we'll see if that ends up being the case this go around, as it's not taking us as many weeks to get there as it did the last couple of times. So on the other hand, one of the other bigger movers that we saw this week, as you saw, was bond yields, right? So bonds, here's their week here. You can see down near the lows, that their recent lows. They had a much bigger down week last week, and they stayed down this week. You can see TLT is down there. If you look at TNX, TNX up 8 basis points, back up to 4.16%. So we ended up closing the week at the highs of the week thanks to that PPI, despite the fact that we were down to right around 4% at the lows of the week. So pretty significant. I mean, we had come down off of the highs last week, and now ended up finishing at this is the highest level. I mean, we finished here at 4.156. We finished here at 4.21. This week in October was the highest week. This week now is the second highest week that we have closed on the 10-year yield, and the momentum is just picking up, right? We're not slowing down. We're not converging. These averages are actually moving away from each other as that MACD rises. And it's not necessarily at a high level either, so it's got potential to rise. So the 10-year yield moving, it will have some significant, and the dollar moving up higher will have some significant implications for risk appetite, as will the crude oil prices. As you can see, breaking back above their 200-week or a 50-week moving average, the 8 and 17-week crossing above the 30-week. You can see what it looks like on the daily chart. Flirting with getting out of the value area, well above the 200-day moving average. You are converging now, so we're going to lose some momentum, but we have clearly changed the trend for commodities. One thing I brought up this morning in a Twitter space was, or at least was going to bring up this morning before I got cut off, was the 1 month return rate of change, this rolling rate of change on crude oil, and you can see, we are at a pretty decent level. Like if I zoom out, so you can see where that line is. That line's the high. That's the high that it hit at the end of July. I mean, if you follow that line across, that's a pretty decent. I mean, that's one of the strongest 1 month returns that we've seen in crude oil. Outside of some significant moves, of course, but just in terms of standard moves, that's a pretty strong move. And you're flirting with getting back above this important Fibonacci level and working our way back up towards 100. I don't think we get above 125, but I definitely think we can work back towards 100, which obviously means that inflation expectations are going to start to slowly ramp back up again. You look back to where inflation was at its worst. It actually hit its worst here in June of 2022. But for most of 2021, when things were as high as they were, that we're back to those levels of early 2022 when this all started, before of course the Ukrainian invasion that had that run right there. But we're back to those levels where this whole correction started because of how strong commodity prices were. So that kind of goes to show just how strong things are now. We're not there necessarily on actually we are higher than where we were on commodities in general, than where we were at the beginning of 2022, even though crude oil is where it was at the beginning of 2022. So commodity prices remain stubbornly high, and if they continue to pick up the pace to the upside, then that will just pick up the pace for the month-over-month reads on the headline CPIs. You can see we're above the 200-day, above the point of control. Even if we're converging, we're converging sideways above some very important support levels. So if we were to converge and get a weak consolidation and bounce, then we can maintain the move above and get the long-term trend to turn around, which was not bullish in 2022. And so we'll see if that ends up being the case going forward into the end of this year. Let's take one look at the sector rotation and how they performed today. Let's go back to just this week. Let's go to the week here, August. From the beginning of the week, and we'll go about 10 minutes. You can see energy was the biggest winner. Again, energy is not the biggest winner during bullish periods for the equity market. So technology is typically the biggest winner, and it was actually the biggest loser this week. And I've shown you this chart too in the past, the ratio chart of XLK and how it's performing. It has such strong momentum against the rest of the market. But look at the last 2 weeks. Look at the big breakdown in XLK, breaking below its 8-week moving average, flirting with that 17-week moving average. Look at the relative strength chart. Look at the RRG really breaking down hard, momentum falling, but we were so high that it's got a lot of room to falter. And if you look at that relative strength with all these different lines here, let's go SPY. If you look at that relative strength chart with all these different moving averages, let's go to the 1-year chart so we can zoom in a little bit. you can see we are clearly filling in the gap between the 50 and 200 day moving averages, 30 days crossing below. Like, we are dropping big momentum that we haven't seen this much momentum. Like, it's as you saw in 2022, it's hard for the markets to be bullish when XLK is underperforming the markets, especially to the degree with the momentum that it's doing right now. That is significant downside momentum, that you would expect would continue to put a lot of pressure on broader market, on the broader risk appetite just in general. XLE, on the other hand, if you take a look at, which had been underperforming during this rally in 2023, is starting to pick it up. Look at the RSI for the relative strength chart, up above 70 again. You're filling in the gap between the 50 and 200. Again, it was bullish most of 2022, so it's not necessarily the best sign for the stock market when energy is the one leading the way and leading the way higher as much as it is. I mean, that's a pretty sharp move up from, not as low as it was in 2020, but about as low as it was in 2021 when it started to rally during the correction, and you're getting some strong momentum to the upside, and you're about to cross above the 50-week moving average. Like, things are looking a lot better for a sector that I don't know necessarily we want things to look a lot better for because of the inflationary aspects of it. All right, so for our trade idea of the day, I wanted to take a look at FCX, which is not necessarily in the energy sector, but it's actually in the materials. It's actually correlated, right, with the energy sector and the materials sector. But materials is not. I mean, materials is a little bit more correlated with like economic growth expectations. FCX is in that space. Freeport-McMoRan. You can see it got a bull tag. It did not drop below the moving average very much, but it got a bull tag. Last time it kind of got a quasi-bull tag. It didn't quite finish below the moving average. It's barely above it. We bounced up pretty sharply. We're at post earnings now. We did get a cluster. Are we going to bounce up pretty sharply here? Or, see over here, the intermediate line was not falling below market sentiment. And the near-term line was actually coming down from the reversal zone. Not the case this go around. Short-term sentiment's more bearish. You are below market sentiment now. So there's more potential for some downside moves, especially as you see, its weekly charts, kind of like the S&P 500, showing signs of transition from bullish weekly trends to a bearish trend. You can see there, again, looks very similar to the S&P 500, just off by a week, right? So with the transition here, you expect next week to be more of a bearish week. And when you look at its 3 green arrow chart, today's decline dropped below the 17 and the 30-day moving average, which tends to be more significant as both the MACD and stochastics are dropping below their moving averages. But you notice there's quite a bit of support here, like, while we might be reversing from an old high point, you got, move 50 and 200 day averages, you got the point of control, you're in the value area, so you expect that you will move towards the point of control, but that's a pretty strong support, so there's not a whole lot. I mean, we looked at, other trades that have a lot more downside potential, and we were a little bit more aggressive, but this one's got, while it is looking pretty decent for a bearish move, not a whole lot of directional opportunities. So, but there's some resistance there, so that sets us up for doing a bear call spread. So in this case, selling what was, when we did this during the Market Outlook Live, it was a little bit closer to the mid 30s delta. Sell that, buy the 2 strikes away for protection. You can see what it looks like here on the Analyze tab. Position size for the full, because I don't have to worry about the earnings. And getting a pretty decent reward for that. That break even, you can see, is on the chart here. We'd have to fill back into this gap here and then some for us to get to the point where I'm losing $400, and that's how much I'm willing to lose, because that's what I'm trying to make. So on a short credit, on a premium credit spread, I'm basically willing to lose what the premium is. I'm position size to lose a full 1%, which is what I'm normally willing to risk. I mean, if I lose it, I don't want to, but it wouldn't kill me. I'm willing to lose $1,000, but I'd prefer to get out earlier and with only $400, because that matches my return, and it's easier to offset that kind of a loss with a new trade, when that happens. So harder to offset a $1,000 loss. Though again, I'm willing to lose $1,000. That's why I position size around that. But again, if things would have to turn around, and before so I'm not going to get out just because it moved up to 42 or up to 43. I'd have to really break through this gap and then some for me to say, okay, I'm done with this trade. So like I said, on the daily chart, this is where that's break even's at. So you'd have to get back above these old high points over here. All right, so get back above these recent highs and get moving back above the 8 and 17 day, and we're going to be back to being bullish again. MACD will probably turn up by then. We don't want to be in that bear call anymore, and would be willing to take whatever small loss I had and just move on to another trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.